Hi everyone and welcome to Investing in Canada. The objective of this course is to help you make your investments in the most efficient way. So let's start with today's topic. So if you haven't done it yet, please subscribe and activate the notifications. If you like videos like this, our channel is EduFin Wizards on YouTube. You can get access to the complete course on Udemy or Skillshare. The links are in the description. Okay. So let's continue with the topic that we were discussing. We were discussing real estate as an asset class. So we have already discussed ways of investing in real estate. We have discussed benefits of investing in real estate, things that impact real estate prices. So these are the previous videos that I had already recorded. So this time we are going to look at things to do when you're buying your first house. That is specifically we are going to talk about mortgage strategies. Okay, so let's continue with the topic. So first thing that you should do before buying a house is get a pre-approval for the mortgage. So you can go to a bank or a mortgage broker and then get a pre-approval for the mortgage that you qualify for. So what do they do? So pre-approval gives you a rough estimate of how much mortgage you can qualify for. It eases the home buying process because you don't have to worry about financing later on. It also helps you to freeze the interest rate in case there is a potential of interest rate increase, because let's say the interest rates are increasing like it is in 2022. So you can go to a bank, get a pre-approval and freeze your interest rate, right, while you start your home search. Okay, so that's a big benefit of getting a pre-approval. It factors in the down payment you have. So they will ask you for the down payment, how much down payment you got. It factors in payment, like it factors in your credit rating, how trustworthy are you as a consumer, and it factors you all other things like your debt ratios and stuff, and they give you an interest rate that is based on all of this: how much down payment you are putting, what is your credit rating, and how much other debt you have. Based on that, the bank is going to give you an interest rate. Okay, so you can either do this pre-approval process with a mortgage broker or with a bank. Mortgage brokers are people who are like agents of different banks. So at a single location, you can shop around for various products of different banks, or you can go with a straightforward bank in which you engage with a bank employee. You can either get a fixed rate, 5-year, 10-year is the most popular fixed rates, or you can get a variable rate mortgage. What is a fixed rate mortgage? Your interest rate doesn't change. It doesn't depend on the market conditions. Variable rate mortgage, your interest rates can change. If the interest rates in the market go up, your mortgage rate is going to go up. If interest rates in the market goes down, so your mortgage rate is going to go down. So this is the concept of pre-approval. So what's a mortgage? So mortgage is the total payment that you're going to make on the loan. So principal is what you borrow. So when you take on a mortgage, principal is something that you borrow. So let's say it's a house of $420,000 and you borrow $400,000 on it. So 400,000 becomes your principal. On top of this principal, because of the interest rate that the bank is charging over the period of the mortgage, let's say 25-year mortgage, you're going to pay interest on top of that. So the principal is how much you're borrowing. Interest is the total charge that they are going to charge you in those 25 years based on the interest rate on your mortgage. Plus, if you are borrowing, if you're putting down payment less than 20%, then they will also charge you CMHC fees that is added into your principal. So CMHC fees is something that they charge you if your down payment is less than 20%. Now, this is a mortgage. Mortgage is principal that you borrow, the total interest that you pay, and CMHC fees in case the down payment is not enough, like that is less than 20%. Now, on this mortgage, you make a mortgage payment. So each mortgage payment that you pay, maybe it is monthly, weekly, bi-weekly, you have the principal repayment that goes towards principal, and then you have interest repayment, that is the interest that you are paying. So this is how a mortgage works. So you borrow, then you pay it back over the years. This is an example of a mortgage. So if you're putting down payment less than 20%, then they will charge you something called as CMHC fee. What is CMHC fee? It's an insurance fee that the banks ask you to get. CMHC insurance is insurance on your mortgage. So if you default, then the banks will get their payment from CMHC. It's a federal company, it's a federal corporation, it's a crown corporation, CMHC, that pays the bank in case you default. It generally you have to pay CMHC fees if the down payment is less than 20%. So in this example, the house value is 420,000. The down payment you're putting is 21,000. So it is clearly less than 20%. So they will charge you a CMHC fee of 15,960. You can check online. There is a CMHC fee calculator. You can input in your own figures and they will give you the fee that they are charging. Okay. So your total mortgage is your house value 420,000 minus the down payment plus the CMHC fee. So CMHC fee always gets added to the house value and the down payment is subtracted from the house value. So in total, you are actually borrowing $414,960, okay, from the bank. Let's assume the interest rate is 4%. So your mortgage payment comes to nearly 2183. And on this mortgage, in total, you're going to pay an interest of $239,000 over the next 25 years, assuming it is a 25-year mortgage. So this is a very good example of how mortgages work in Canada. You borrow from the bank based on your down payment. If you're putting down payment less than 20%, straight away they will charge you CMHC fee. You can pay this fee upfront, or most of the time it gets added to the house value. So actual borrowing that you get from the bank is house value minus the down payment plus the CMHC fee. Based on the interest rate, you will get a monthly payment from the bank. So in this case, it is 2183. And because they are charging you interest over the period of 25 years, you are going to pay $239,000 in addition to whatever you have borrowed. So this $414,960 you have to anyways return in the next 25 years. Plus on top of that, you also have to pay $239,872 as interest. So this is an example of a mortgage. Now this mortgage you can negotiate with a bank or you can negotiate with a mortgage broker. It's good idea to shop around because mortgage rates are very different across banks. So you can probably get a good deal if you shop around, and especially through a mortgage broker. Now, first thing you can do as a strategy of saving money is you can save on CMHC fees. So put up as much down payment as you can, because the higher the down payment, lower will be the CMHC fee. This CMHC fee gets added to the mortgage, so you pay interest on top of that. So you save a lot of money if you are able to accumulate the CMS, like accumulate 20% plus down payment. So I've given you an example. So in the original case, the house value was 420,000. The down payment was $21,000. CMHC fee calculation came around 15,960, right? The total mortgage we saw was 414,960. Monthly installment came to 2183 and the total interest paid was 239,872. This is the previous example. Now, if you were able to pay $85,000 as down payment, right, which is clearly more than 20%, so CMHC fees will go to zero. So you are in total borrowing $335,000. Your monthly payment will go down because you're paying more upfront. So it will be $1,762, and the total interest you would have paid on this mortgage will be $193,000, $193,650 to be very precise. So straight away, by paying extra and saving on CMHC fees, your interest gets saved too. So your total savings in interest is $46,000, right? Because you're paying extra. Along with that, you also save on CMHC fee of 15,000. So your total savings crosses around $60,000 plus if you can come up with a 20% down payment or more. So it's a good idea if you're not in a hurry to buy a house, or it is an investment property that you're accumulating for, right? Or you're going to rent part of it, then it's a good idea to try to accumulate at least 20% of the property value. Okay, you save on CMHC fee. CMHC, it's an insurance fee, it's a fee, so it never comes back to you. Plus, if it gets added to the mortgage, you pay interest on top of that. So it's a big pain point. So try to save on CMHC fees by accumulating more than 20%. Then you can also be smart about your mortgage and choose a tenure that you can actually choose a payment that based on your budget is the maximum you can pay, irrespective of what the bank is offering you. So I've given you an example. So original loan was 25, there are two options. You can take a 15-year loan, or you can take a 25-year loan, like 15-year mortgage or a 25-year mortgage. Same things, house value 420 in both cases, down payment 85,000, CMHC fees are 0 because you paid 20% plus. So total mortgage is 335. Now if you choose a 15-year tenure, your monthly payment will be higher. So it will be $2,472. So if based on your budget, you're able to manage that, right? The total interest that you would pay on this house will be $110,000 over the 15-year period. But if you are taking a 25-year mortgage, then the payment will be less. The monthly payment will be less, $1,762. But the interest paid throughout the 25 years will be way higher. It will be $193,000. So in fact, if you take a 15-year mortgage instead of 25-year mortgage, you would have saved $83,000 in interest. So always choose a tenure that maxes out your monthly payment based on the budget you have. So this is the second part. The first part we saw, don't pay CMHC fees, save up on them by accumulating 20% plus. The second part, try to match the tenure that matches your budget, not what the bank gives you. Bank will probably prefer you to give a 25-year mortgage or a 30-year mortgage because they get paid more. Right, especially variable rate loans, they are not taking interest rate risk. So it's a good idea to go for the tenure that matches your preference of budget rather than bank's preference. Lower the tenure, more savings you will get in terms of interest. Okay. Now, third strategy that you can employ is a decision between interest rates. So there are two types of rates available in the market. There are fixed rate loans, fixed rate mortgages, or there are variable rate mortgages. So fixed rate means over the period that is given in the fixed rate tenure, right, the interest rate would not change. After the period gets over, you have to negotiate with the bank again. So example will be a 2-year fixed is currently available from RBC at 5%, 5.09 to be precise. So if you choose this option, for the next 2 years, your interest rate is fixed at 5%, right? After that, you have to go ahead and negotiate. 5-year fixed is available at 5.54%. So 5 years it's going to be fixed. After that, you have to negotiate again. If you go for a variable rate means that the interest rates are not fixed, right? They keep on changing based on the interest rate in the market. That is the prime rate. Prime rate is decided by it is a derivation of the Bank of Canada rates. So Bank of Canada decides the interest rates, then the individual banks decide their own prime rate based on that, and that is what you get. Variable rate means if the interest rates keep on going up, your mortgage interest rate will keep on going up. If the interest rate drop, your mortgage rate will drop. So you can choose either fixed rates or variable rates. So what strategy should we employ? So in the market, if there is high inflation, so if the inflation is high, like in 2022, inflation is 7% plus in Canada, right? Where our target rate that Bank of Canada has is 2%. So it is 5% more than our target rate right now. So what happens when inflation is high? The Bank of Canada is going to increase the interest rate to combat that high inflation. So there would be expectation of increase in interest rates. So whenever inflation is high, probably the interest rates are going to go up in the near future. So what should be the strategy, or what strategy you could employ? You could go for a fixed rate mortgage. You could freeze your rate right now so that you don't have to worry about increase in interest rates. So this is when the inflation is high. When we are in a low inflation period, like before pandemic, the inflation was quite low, sub 2%, right? And let's say there are economic problems. The economy is slowing down. There is a pandemic coming. So what will Bank of Canada do? Bank of Canada will try to stimulate the economy by decreasing the interest rates. So in that case, you can go for a variable rate mortgage. So depending on what is the situation, right now it is high inflation. So interest rates are going up. You can freeze your fixed rate, right? Sometimes there is low inflation or there is economic problems. So probably the interest rates are going to go down. Then you should go for variable rate, because when the interest rates drop, your interest rate drops on the mortgage too. Okay. So decide carefully. Also, there are types of mortgages that you can choose and strategize based on that. So mortgage types are two types, open and close. So open mortgage is one which has flexible options to increase your mortgage repayment. That is, you can repay your mortgage faster when it is an open mortgage without any penalty. So either by increasing your regular payments or via a lump sum amount. A closed mortgage, on the other hand, will penalize you for paying off all or part of your mortgage. Okay. So open mortgage, you don't have to pay any penalties if you try to prepay your mortgage. Prepay means putting money straight towards principal. That doesn't go towards interest. The principal reduces. In a closed mortgage, there are penalties if you try to do that. Now, prepaying your mortgage, if it is an open mortgage, is a very good option. So I've given you an example. So if the loan that you took is $415,000, that is roughly what we were discussing, 4% interest rate, and the original tenure was 25 years. Now, if you prepay $10,000 every year, prepay means $10,000 you save up and you tell your bank that I'm prepaying the mortgage. So that 10,000 straight away goes towards your principal. So your principal amount goes down. So you save on future interest. So if you create a strategy by prepaying $10,000 every year, so what happens? The total loan tenure from 25 years will shrink to 15 years. So total loan reduction will be 9 years and 10 months. So almost 10 years you will pay less. So instead of paying for 25 years, you will finish off your loan, finish off your mortgage in 15 years. So total interest that you would save, right, will be $104,000. So always create a strategy that enables you to prepay your mortgage. Okay. It's a big saving. Other prepayment options that you can look at, you can straight away put money towards your principal if your bank allows that. There are some interesting ways that banks allow. So you can increase your payment frequency. So you can save interest by increasing your mortgage payment frequency. When you select an accelerated weekly or bi-weekly payment option, you're essentially making one extra payment every year that helps you to pay your mortgage faster. So most bank gives this option where you can go for accelerated weekly or bi-weekly payment. It means every year you will pay one extra payment that goes straight to your principal. You can also use double up option. It gives you the flexibility to prepay any amount between $100 and the equivalent of principal and interest portion of your regular monthly mortgage, right, on any given payment date. Double up means let's say your mortgage payment is $1,500. Once a year, right, or depending on the bank, you can pay $1,500 extra. So you can double up your payment to $3,000, right? This is an option that banks can give. Third is you can increase in the monthly payment. So you can pay up to 10% extra every month based on your mortgage payment. So let's say your mortgage payment is $1,500, so you can pay $150 extra on top of that. That $150 will straight away go towards principal. So you can use all these strategies to reduce your mortgage tenure and save on interest. So these are the strategies that we talked about. Use all of them. Try to accumulate at 20% plus down payment so that you save on CMHC fee. CMHC fee is compulsory if you do not have 20% plus down payment. Then try to choose a tenure that suits your budget, not what the bank gives you. Pay as much as you can on a mortgage. Third thing, right, especially in an increasing interest rate environment, try to reduce your mortgages. Third thing you can do is prepay your mortgage. And fourth thing that you can do is choose the right interest rate depending on the economic situation. So if you like videos like this, please subscribe and activate the notifications. Our channel is EduFin Wizards on YouTube. You can get access to the complete course on Udemy or Skillshare. The links are in the description. Thank you very much for your time. See you in the next recording.